What's spooking the markets? Ghost projects, tariffs, weak peso, corruption, maybe all of the above. Let's analyze the situation. And for this episode, let's ground ourselves with another discussion on reading company fundamentals. Let's discuss. My name is Dan Slim, and welcome to another episode of Monday Market Outlook. So finally, President Donald Trump and President Xi Jinping met in South Korea and agreed to a one-year trade truce over rare earth elements, easing tensions that had risked further escalating the trade war between the two countries. China will pause its export controls on rare earths, while the US will cut tariffs on Chinese goods and postpone certain trade restrictions. Both committed to reciprocal visits in 2025, marking an uneasy truce in their long simmering trade conflict. This news, combined with fresh earnings reports from the Mag 7, reignited optimism on sustained growth among tech megacaps, particularly Microsoft, Amazon, Alphabet, and Apple. So easing concerns about overspending on AI infrastructure helped drive the S&P 500 to a strong October finish, gaining nearly 2.6%. So in fact, the S&P 500 is currently on a 6-month win streak, with the last 3 quarters posting a combined gain of 7.9%, marking the strongest third quarter performance for stocks, no, including the Nasdaq and the Dow since 1986. The US Federal Reserve executed unexpected 25 basis point policy rate cut. The argument to cut or not to cut was split, no, between Fed Governor Stephen Myron, who wanted more off the top, and Kansas City Fed President Jeffrey Smith, who voted for no cuts today. So it's been two meetings where we've been seeing increasing dissent over the policy decision. However, Fed Chair Powell's subsequent comments introduced uncertainty, stating that market price cuts for December and 2026 are far from being a foregone conclusion. Well, he said a lot of things. He also said that core PCE could have been lower if not for tariffs. He also said that the downside risk to employments have risen. Quantitative tightening will end on December 1. And, the government shutdown has delayed key data releases. September's jobs report is still pending, and October's jobs and inflation reports are postponed. So when you are driving in a fog, you slow down. And again, the Fed is still absolutely committed to a 2% inflation target for the Philippines, right? If the Fed pauses this December, this could add further pressure to the peso, especially after recent forward guidance from BSP Governor Remolona. As we head into a busy week for economic data, investors will be watching three key indicators, right? Inflation, unemployment rate, and GDP growth rate. Concerns about a slowdown are starting to build, with Finance Secretary Ralph Recto noting that the government's recent anti-corruption reforms may have temporarily weighed on growth. So economists now expect third quarter GDP to come in at around 5.2%, down from 5.5% in the previous quarter, which could force the BSP to cut rates to pump prime the economy and offset the slowdown in growth. So with the rate differential down to 50 basis points, this could lead to a resumption of weakness in the Philippine peso, which in turn could weigh on the markets. So last week, the peso weakened to as much as 59.26, no, before recovering to 58.69. But with the breakout, could the peso potentially reach 60 based on measured targets, despite the seasonal influx of dollar remittances during the holidays? Now, looking at the PSEI charts, after spending most of October moving sideways between 6,000 and 6,130, selling pressure returned last week as the PSEI broke its brief two-day climb and slipped nearly 1% for the week to close at 59.29. So many investors seem to stay on the sidelines ahead of the long weekend, keeping sentiment cautious and trading activity subdued. The index briefly tested 6,000, which has now turned from support into resistance before sliding lower, reinforcing the market's downward bias, with the next support level seen at 5,905 and 5,830. On the monthly chart, the PSEI has now been on a 4-month losing streak. So ever since Trump's election back in November, when global markets were rattled by renewed tariff threats and trade war fears, no, the local markets has struggled to regain its footing. And nearly a year later, it still hasn't managed to stage a meaningful recovery. On the weekly chart, the market initially consolidated again between 6,000 to 6,100 range before renewed selling pressure dragged the index to its lowest levels since January this year. Looking back at November, let's look at the sectoral performance of the market. With the growing expectation that the BSP could cut rates in December, bank stocks were among the hardest hit, with the financial sector down 4.16% as investors grew concerned that lower interest rates might squeeze their net interest margins. Companies that are also sensitive to forex moves also corrected, with the services sector here in the red, pulling back in the last weeks. So the mining sector, of course, saw a sharp correction as gold prices dropped. As we all know, this is a disappointing time for the markets, and with most stocks at oversold or even very cheap valuations, it might be a good time to revisit some core concepts in fundamental analysis. Now, times like these can be opportunities. When prices are down, that's when real value often hides in plain sight. And let's try to identify these companies with that are so healthy and resilient that it almost feels unfair how cheap the stocks have become. While reading financial statements can be tedious, comparing one figure to another and making sense of all the numbers, financial ratios make that process easier. By looking at ratios, you can quickly spot a company's strengths or weaknesses at a glance and get a clearer picture of how it's really performing. So let's go again to trading view, and I've managed to filter the stocks here based on only companies with a market cap greater than 10 billion. So you can easily choose the market, filter the market to just the PH markets, and just select PSE all shares. If we are looking at a normal financial statement, you have your top line and bottom line. So we've discussed this in our previous episode, your total revenue and your net income, top line, bottom line. When you compare these two numbers, no, it's hard to compute. Pure Gold has 220 billion in total revenue but only retained 10 billion in earnings. So that's a small portion of 200 billion. How many percent is that? And that's where ratios come in. So ratios are basically two numbers compared together. And when you compare certain numbers with another number, you can see an indication of profitability, of efficiency. So basically what we're looking for when we read statements, cash flow, make sure the company has lots of cash, make sure the company is managing their debt properly, etc. So financial ratios also show these things. So I've customized the columns here to their relevant information that I want to see. So basically, I want to look at companies that are growing not only this year, but over the last 5 years, 5-year CAGR, which means compounded annual growth rate. So either with their revenues or with their net income. So net margins basically compare their top line and their bottom line. So it gives you a sense of how much the company is spending and how much they are retaining in earnings. Now, return on asset, what this basically means is that, for example, if there are two video editors, now both video editors are using the same machine worth 100,000 pesos, right? So editor 1, editor 2, 100,000 peso machine, 100,000 peso machine. Well, generally, if you compare two editors or two companies or two persons, one will be more efficient than the other. So, for example, if editor 1 makes 50,000 pesos and editor 2 makes 20,000 pesos, using the same 100,000 peso machine, we would naturally know already that editor 1 has a higher ROA. So it gives you a 50% ROA. So that's what ROA is. So it's basically how the company uses its assets, its resources to generate income for you. Now, ROE And ROIC is basically return on equity and return on invested capital. So what this means is that, for example, if I'm a business owner and you invest 1 million in my business, right? And my business generates 100,000 pesos. So that means that's a 10% return on equity to you, right? But for example, aside from the 1 million that you gave me, I took out a 1 million loan from the bank. So now instead of a 1 million capital, I have 2 million capital and I make 100,000 for that year. So 100,000 versus your equity, which is 1 million, that's 10%. But in reality, I used 2 million to generate 100,000. So my return on invested capital, which is the total, your equity plus my borrowings, generated only 5% ROIC. So for me, gives a clearer picture on how efficient the company is in using total capital, which includes shareholders' equity and loans, no, to generate income. So some companies may borrow more compared to the equity that they use. Like for example, ICT. If you look at ICT, look at the ROE. Return on equity is 82%. Great numbers. But the ROIC is down to a modest 15%. Actually, anything more than 10% is actually very good. No? So it's not really modest. But you see the disparity here. So meaning ICT's total capital, a large part of ICT's total capital comes from borrowings, which is why their debt to equity ratio is 4. Right? So what the debt to equity ratio is, like if my equity is 1 million and I borrow 4 million from the bank, that's a 4 debt to equity ratio because I owe 4 million and I'm only worth 1 million. And usually when you are leveraged that much, banks will uh, tend to have second thoughts. Well, banks would probably not lend you money if you're that leveraged. So, but that's not the only thing that banks look at when they lend you money. They also look at your capacity to pay, right? So, your capacity to pay is uh, expressed here in the EBITDA interest coverage column. So, it shows you how much of your cash flow is allocated to paying interest. So if your interest coverage is less than 2, right, that means that most of the money that you earn goes to interest payment, and that's a bad thing. So if you look at companies with very low EBITDA interest coverage, look at San Miguel Corp. They're leveraged 6 times. They're leveraged 6 times, and their interest coverage is already 1.78, meaning most of the money that they make is used to pay off interest only. And that's very concerning for a company to be allocating most of their earnings just for interest payments alone. Let's look at ATI, Asian Terminals, right? So just to put all of these things together, Asian Terminals, growth rate in the last year, 19%, in the past 5 years, 4%, net income, 40%, in the past 5 years, 4%. Usually this means that the company was in investment mode in the previous years and they are earning the rewards of those investments this year. Look at the net margins here, 37%. This is really very good. Anything over 20% is great. 15% ROA, 23% ROE, ROIC, 17.31 debt to equity ratio. For a defensive company, this is a very good debt to equity ratio. They don't owe a lot of money. And look at their interest coverage, 21.27, 4.8% dividend yield. So we can easily see here why ATI is one of our favorite companies. If you look at ratios also, you would probably notice that REITs have a ridiculously high net margins. And actually, when you look at ratio, you also have to look at it on a per sector basis because some of the numbers here are sector specific. For example, let's first go to financials. Right? For financials, generally, the margins would be at around 29%, 30%, 22%. These are the normal margins, right? But look at the ROAs. It's very low, 2%, 1%. And this is normal for banks because of the way um, earnings are computed. The structure is different. It's interest on money that they hold, and the way it's accounted for gives these numbers, which is normal. The normal ROA for banks are just this low. But look at the ROE. Right? They have healthy ROEs in the past year, basically because interest rates are high. Net income is growing in the past 5 years. And we can easily see that the banking sector has been very healthy. And let's look at the laggards here. Somebody asked me why Security Bank is underperforming, and this is probably the reason why. And if you look at the ratios, the ROIC, the ROE, Security Bank is lagging against the other banks. So we have BDO, we have Metrobank, we have BPI. I mean, even PNB have great numbers. AUB also has good numbers. Now, let's look at industrials. So industrials, you will see that the margins for consumer companies like Monde, JFC, URC are particularly low. Even JFC, look at the margins here, 3.5% only. For a big business, how can you have a 3.5% margin? It's actually pretty normal for consumer companies to have very low margins because they depend on volume. So among the consumer companies, I mean, URC even has a better margin. ROIC is below 10, which is not really too good for the consumer stocks right now. But the likes of pizza, right? Good numbers. But of course, our favorite Century Pacific, right? Look at the growth here, 8%, 13%. Look at the net margins. I mean, among the consumer stocks, Century Pacific has been able to manage their cost pretty well to maintain decent net margins. ROA 11%, 18, 16, double digit numbers here. They don't owe a lot of money. 3.14% dividend rate. So easily why CNPF is one of the top choice. No? And if we look at utilities, the net margins would be a bit higher, right? 19%, and Keeper, right? Double digit growth this year. Look at the net margins, ROA, ROE, ROIC. They don't owe a lot of money. 5.15% dividend rate. And again, this is easily why Keeper is one of our favorites. GSMI, double digit growths in the last 5 years. 34% net income, 5-year CAGR. 12% margins, 24, 35, 35. What a great uh, company, in terms of financial. Zero debt, 5.72% dividend yield. So you can easily see, which companies will be resilient despite the downturn. Let's look at the property sectors here. Net margins for REITs will be ridiculously high. Some asset infusions would inflate this to more than 100%, but it would be normal for companies like Ayala Land to have margins like 30%, 16%. Now, if we are going to compare SM Prime with Ayala Land, and you look at the numbers, we can clearly see a winner here. Look at the growth rate for SM Prime and the growth rate for Ayala Land. Look at the margins. Look at the ROAs. Look at the ROE, ROIC. I mean, SMPH across the board leads Ayala Land, even the debt to equity ratio. So even Mega World and Robinson's Land have better looking numbers compared to Ayala Land, which is probably why Ayala Land is getting battered right now. So let's look at the mining stocks, and this is again clearly why Apex Mining is a clear favorite. Look at the growth rate, net margins, very healthy net margins, return on assets, return on equity, ROIC. They don't owe a lot of money, capacity to pay 8.32. May compare that with the likes of Philex Mining, 8%, 1.45. So there may be some deterioration in the quality of yield, or they may have invested, or the low numbers may be because of the investment in new mines. OGP also quite low ROA, ROE, ROIC numbers, but dividend yield 9%. So depends on your strategy. And lastly, if we look at services, right, we can easily see why STI is a good pick also. Look at the numbers here, double digit ratios here, and especially ICT, right? Look at the growth rate, 20%, 53%, 86% in the last 5 years. Margins at 28%, double-digit ROA, ROE, and ROICs. Debt equity, a little bit high, but they are able to pay it off. 5.34, a bit low, but not too alarming. Converge also, I mean, despite the drawdown, look at the growth rate, look at the margins, and look at the return on equity and ROIC. Debt, manageable, 15. These are actually good numbers. So don't be afraid to buy the dip on Converge. Now, DigiPlus also one of the best looking financial ratios in the market. GMA also very good ratios. If you compare PLDT with Globe, we can see a clear winner here. PLDT with better ratios, better growth. The telco space in general, suffering from low growth rates, but we can see higher yields also from Tel. Wilcon versus Pure Gold, we can clearly see the better company. With that, no, I hope I was able to provide some useful information on financial ratios. Of course, there are nuances to it, and we've only covered the bare minimum to get you going. But do start to look at this and use what you see to ask the right questions. But also remember, I mean, fundamental analysis, this kind of analysis is only one piece of the puzzle to make truly informed decisions. You also need to consider technical analysis and most importantly, what I'd like to call experiential analysis, right? So verifying what you see in the financials with what's actually happening in the business and its broader environment. You need to connect the dots between a company's numbers, its forward guidance, and the macroeconomic backdrop shaping investors' sentiments. Now, for example, if you look at DigiPlus, it has the strongest financial and ratios in the sector. But despite that, government regulations and the environment continues to cloud its forward outlook. And the market, of course, is pricing that in. On the other hand, if we look at SPNet, financials look weak, actually almost uninvestable. But the story changes once you factor in their Terra Solar project, which is a massive initiative that could transform its long-term prospects and investors. Again, if you look at the charts, investors are already looking ahead, anticipating a recovery in the next few years. So hopefully, these insights give you a clearer lens on how to separate short-term noise from long-term value. Some stocks are down simply because the market as a whole is weak, not because their businesses themselves are. And when the market eventually bounces back, these strong, fundamentally sound companies are often the first to recover. Now, combining fundamental, technical, and experiential analysis, you'll be better equipped, no, to spot true bargains and make smarter, more confident investing decisions. So that's it for this week. Please like this video if you found the information useful, and please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly, and I'll see you again next week. Bye-bye.